This is our Forex blog for October 2nd, 2012. And like we do most days, the first step of our three-step Forex trading system is to use our currency meter and identify which currencies are strongest and weakest. You can sort this, and you can see the euro, Swiss, and pound are the strongest over the last hour. Statistically, the euro is going up against 100% of other pairs. The Australian's going down against 100% of other pairs. CAD's second weakest, and then the dollar. And most traders, including myself, trade dollar pairs and euro or yen pairs. So the real-time trends on the top: 15-minute trend, hourly, daily, weekly, monthly. Obviously, the more time frames that are up, like the euro today, you want to trade that against one of the weaker ones. Now, the dollar right now has a little bit of weakness, but it was mixed throughout the day. You know, a little bit of strength for 30 minutes, then a little bit of weakness, strength for 15 minutes, weakness. The 15 and hourly trend were down. The longer-term trend was mixed. You're going to have an easier time trading the super strong euro against the weakest one, which is the Australian. So let's bring up, to make it easier, let's go to a 5-minute chart. Let's bring up the euro Australian. Super strong euro, super weak Australian. And you can see, obviously, this had to be due to a news event, shot up about 75 pips. And then basically there's two methods that you want to use for entry. One is a sideways rectangle, or in this case wedge pattern breakout. You know, most of our entries are rectangle patterns. This is kind of like a flag, and when it broke out, you know, you can see it only went up a little bit more. Typically after markets move up, you want to have a little bit deeper pullback. I would always draw my fibs on that whole wave and hope it goes down at least close to the 38% level. And typically, once markets move a lot, you're going to get it, you know, the farther up it goes, you want to wait for a two-wave pullback. So there's one wave, two waves. That's usually a little bit safer. Or if you want to wait for a two-wave pullback and then the trend line over the highs to get broken, pretty high probability trade. Now at that point, you can see it went up and it didn't take out the high from before. So at that point, you really don't know if this trend's going to continue or not. If you're a very cautious trader, you might want to just wait for that area to get broken. Typically, trends reverse after double tops. Very rarely is there a time where a level gets hit 3 times and can't penetrate. Usually, triple tops cause huge moves down, and when they don't, you're going to get another move up. So when it broke out right here, very high probability. You can see from the fib target from the high to the low here, went right to the 1.382 fib target, and it's been stalling. But nonetheless, you would have taken this trade here at 40, and you're out somewhere up here at 80 for a nice 40 pip move. If you wanted to make sure you didn't get stopped out, you'd put your stop underneath the last low right here. And so if you bought this around 40, your stop would be at 20. You'd risk 20 pips. In this case, the profit target's 40 pips. If you're going to take trades like this, if you have to go to work or leave, you can put a wide stop like 20 pips and then put your profit target, you know, 8 to 10, 15 pips underneath the Fibonacci profit target. And the key to trading is bigger wins than loss. You can see this is at least 1.5 to 1.8 times bigger than what your risk is here. And that's the key to trading. And when you trade the super strongest ones versus the weakest, you're going to have, you know, a lot higher odds. The second weakest one was the CAD. You can see the monthly trend was very weak. The weekly trend is just slightly weak. The daily trend's kind of mixed. And it was just like the dollar had about an hour of weakness, hour of strength. You know, basically, usually currencies will revert back into their longer term trend. This one, the weekly trend's just barely down. The monthly trend's pretty weak. You could be looking at Euro CAD chart for pullbacks and anticipate, you know, that trend going up. So, you know, during that time, Control L brings up our regular drawing tool. You can either draw trend lines off the pullback bars, or what I have on here is a 5-period moving average shifted 2 bars to the right using our very fast digital signal processing technology. It's much faster than a regular moving average and even exponential. So if you get a pullback where it's at least underneath that by at least 6 bars, and the farther up it goes, I will need at least 10 bars underneath there. So you got 1, 2, 3, 4, 5, 6. You buy this pullback right here. You can see it kind of went up a little bit. If you took that trade, you know, I'm very quick to move my stop to break even. This thing's kind of going sideways. I'm going to put my stop here, and it finally breaks out, it stalls right up at the high. I always tend to get out of half my trade at the high or near it if it can't break it, and typically move my stop up, and that would have been a small profit. The market tried to go down again, and anytime you see a low not taken out, if the trend's up and you get a little mini double bottom right here, you can use double bottoms in an uptrend to give you a very high probability trade as well. You would enter there, and the second trade is the one that actually took off. And most of the time, I'm going to get out of half my first trade at the fib target, the 1.382, and if it shoots above that, typically I'll get out of the second half here. Now this is a 5-minute chart. Let's take a look at what a 5 pips per bar range chart looks like. It's much easier to trade off of range charts, and you can see there wasn't a 6-bar pullback on the range chart. You have basically 1, 2, 3, 4 bars underneath there, 5, 6, and it doesn't have to be all consecutive. At this point, I would be looking for buys, so I would have got pretty much tricked into this false breakout right here. But the good news is, it stalled right at the high. If it shoots above there, then you don't really know what's going to happen. Typically, if it goes above the previous high by a few pips, I'll put my stop right at the high, because false breakouts, can come down just like this. So it starts to go up. I typically move my stop up. I would have lost 5 or 6 pips there. And at this point, once it didn't break that low here, you got in again here. And with these range charts, you have a very, when the market's really taken off, there's a lot more bars, so the moving average catches up faster, and you can use it as a good place to exit. Now, this is almost no pullback at all, so myself, I would not be taking that trade. So I would have missed out on some of this remaining profit. But, the key to me, and one of the things that I focus on doing, is keeping the losses small. Trading has the power to transform your life. It can make all your dreams come true and give you anything in life you want, including time and freedom to be with your family, or it can actually destroy your life. So it's very important to keep that in mind. The power of the markets to absolutely ruin and decimate your life is there. I've seen it happen to traders that, for whatever reason, psychologically are not cut out for trading. And during times in my life, probably about 9 years ago, I had a bad year where I lost a little over $350,000 trading due to the loss of a loved one. So, if you're in one of those states, you can't trade. Just take some time off, 1 to 3 months, 6 months, regroup. That money's gone. You start over, and you're just trying to trade to get 10, 20 pips a day consistently. 20 pips a day, 10, 20 pips a day will allow you to double your account every 1.5 to 3 months, depending on how much leverage you use. So let's look at some of the other strong ones. Swiss, strong on all time frames. The Australian, you saw, was very weak. The Australian is on top of that particular pair, so we're looking to sell the Australian and Swiss. Let's bring this up. Now, I just had a big drop earlier in the day. Again, I want to see at least 6 bars above this displaced moving average to avoid unnecessary and early entries. So you got 1, 2, 3, 4, 5, 6. At this point, if it goes down below the low of those bars, you go short. And it's a little bit early into the trend, but it prevented you from getting into a trade here and having a loss. And the reason I'm going over this is because I've been doing extensive testing with signals and making sure to put in counts above the displaced moving average for a pullback in a weak trend. And I found that 6 bars is a good number to catch a lot of good trades. Occasionally misses some. Sometimes you get a little bit of pullback like this and then it shoots down, and we'd miss those obviously. But the point is to protect the capital and not have unnecessary losses. So you're short right here, and this green bar, when it goes underneath there, the stop's up here. It's not going away immediately, so as soon as it starts going back down, I'm moving my stop to break even, and you can see it pretty much never closes above that displaced moving average until right here. So you're out somewhere around 96.60. We would have been short up here. We'll just round down to 90. So we made 30 pips on that trade while risking about 10. And you always want to draw fibs on the first fib, first swing. Typically, somewhere between the first and second fib target is, your maximum profit off that wave. So when this thing came down underneath there and started to go up, I personally would have been out pretty much half the trade here and the other half, somewhere here. So my exit average would have been around there. You always want to draw your fibs because sometimes you're lucky enough to get a 38 to 50% pullback. Usually you can buy or sell at the 50%, put your stop right outside the 62, and most of the time you're not going to be wrong. You're going to have a small loss, small win, break even, or sometimes huge profit. Notice where it went, right to the 1.3 fib target of this. So again, this is a pretty far move down. So the farther down it goes, I'm going to want more bars above the moving average. You might miss occasional trade, but you will avoid a ton of losses by just simply waiting for a 10-bar pullback. Initially, at the beginning of the trade, 6 bars is enough. This has gone down from 40. It's gone down about 90 pips. So, in fact, I'm wrong, 84 pips. When you draw the fibs, it shows you how many pips it's gone down right there. See that? It's built into the fib target. This is a 28 pip move, 58, 84 pips. So always know how many pips your currency moves in a day. You can do that by putting your range projection on here. And if you go to 1440 minutes, 20 days average, and I always put 1 standard deviation. Typically beyond the 1 standard deviation, you're going to get reversals. So here is how far it normally moves down in a day. This is the 1 standard deviation, which is about 80% likely to be the max low. The 2 standard deviations is basically the difference from here to here, projected down, so it's pretty much at the 2 standard deviation. There's a 95% chance this is pretty much the end of the move. So because it's already moved how much it normally does an entire day as of 1:30, very early in today's trading session, you might want to just be a little bit more cautious in taking the trade. A lot of times when currencies move down like this, they make 2 wave moves up, and most of the time they will go to the fib target of, I'm just going to hit the control button there from this first move up. Typically they're going to go up somewhere between the first and second fib target. This one didn't. So you got to be very careful. Count your 10 bars out. 1, 2, 3, 4, 5, 6, 7. I'd count this one too. 8, 9, 10. So at this point and further, we can start looking for sells. Now, if it broke down underneath this red bar right here, you'd sell it, but it didn't. It went up again. So I'm moving my entry underneath this green bar right here. We have a red bar down, and then we're short right here. And like most of the time happens, the trades don't go your way immediately. It goes maybe 1, 2 pips, comes back up, doesn't stop you out. It's going sideways here. A lot of times I'll move my stop right above the high here because I want to, if the trade's not going my way, I want to lose less than what I initially risked, if that's the case. And because this is the average low down here, I'm, kind of going to be getting out of this trade here because you don't know if it's going to continue. And so your recount starts again once it goes above the moving average. 1, 2, 3, 4. 5, 6, 7, 8, 9, 10. So it's gone 10, pretty much 10 bars, closing at or above. And it doesn't have to be picture perfect. 10 bars at and above the displaced moving average. And so if it breaks down again, this is a low. This is a low. It's a double bottom. It should bounce off. Usually double bottoms are the end of the move. The fact that we didn't get a bounce, the fact that this high up here never even came close to it. This is the second high. It was, about 8 or 9 pips underneath the high here. When it breaks down right here, you're short again. And typically, it's going to work its way down to the fib target, but if it stalls out at the 1.0 standard deviation of the, this has an 80% chance statistically of being the low. So I would exit half my trade there and move my stop above the bar's high here. And it goes down and goes sideways again. I move my stop above here. And typically, the 1.3 at 2 fib target, when it's underneath, even when it's underneath the daily average low, let alone the 1 standard deviation low, that's the maximum move. So get out of the rest of your half here. So I would have been out of half, let's just say at 30, and the other half at 15. So my average exit would have been about 22. Short this up here at 50. So that's a 30 pip profit while risking 10 pips. And that's really the 3 steps of our easy 3-step trading system. 1, use the currency meter to identify the ones most likely to continue to trend. And when all the time frames are, intensely going in one direction, all the time frames, and the Swiss was the same. The Swiss and the euro are pegged together, and the Australian was extremely weak. You're going to have these kind of trades. Now, the New Zealand is also strong, and the Australian's weak. So you could sell the Australian New Zealand as well. And I will end today's Forex blog by going over this one. First thing to notice is that this on this drop hit the average daily low right here. And so basically that was a pretty big sized move. If it's underneath, if it doesn't quite move all the way down to the average daily low, you can wait for 6 bars above. But when it goes to or beyond the average daily low, count for 10. So here's 1, 2, 3, 4. Then it goes back underneath it, 5, 6, 7, 8, 9, 10. And in this case, it happened to time the entry perfectly. And you can see, came back down, didn't quite make the same low, so I would have probably got out of this trade here with a small profit. This is a tough one right here. It made a 10-bar pullback, went down a little bit. You have a 3-bar pullback. This is, if you're looking at the real-time currency meter, you could take this trade. It is not below the daily average low. So if it does go down, you have a good chance of it going to the fib target, which, you can see it pretty much stalled right at the fib target. And if you did take this trade, when it came down to the 1 standard deviation and went sideways, it's only a few pips from here, 27 to 33. It's only 6 pips away. Get out of your trade there, because this was a little riskier trade. And, I hate it when it goes below the 1 standard deviation low, because I usually almost never sell down here. If it went sideways for 2-3 hours and then broke down, you could trade it. This one didn't go sideways enough. So, it's a risky trade. I wouldn't have taken it. It has proved to you that it is going a considerable distance, because the Australian is super strong, the New Zealand's weak, and these a lot of times tend to go in the same direction. Once it's down here, I would look for a 10 or 12 bar pullback. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. If you do short it down here, realize that it's a risky trade. Just try to make 10, 15 pips. Don't be greedy, because a lot of times it'll come back down to the double bottom here and then explode up. So if you shorted this right here, when it's kind of going sideways, move your stop down. It's kind of going sideways. I would exit half my trade here. It goes down a little bit more. I probably would have exited here at the whole number. Whole numbers tend to be, and half numbers too, that's why we label them different, tend to be support resistance. And this has gone down way beyond the 95% likely low. This was a huge move. Don't be greedy. Short here at 17, out pretty much to the whole thing right near the whole number. You made 15, 16 pips on that trade while risking less than 10. And that's a good trade. And so that's how you use our currency meter, our statistical tools, our displaced moving average. If you want to increase your winning percentage, if you're 40 or 50% winning now, I would say you can increase your winning percentage up to 66 to 75, 80%. If you're a really good trader, especially when all the time frames are up versus the other one that's down, by using a displaced moving average using our digital signal processing technology. Wait for a 6 to 12 bar pullback where the close of the bar, whether it's an up or down bar, doesn't matter, is above the moving average, and it doesn't have to be consecutive. In other words, like I showed you on here, 1, 2, 3, 4, goes back down underneath it, 5, 6, 7, 8, 9, 10. As long as the close of the bar is above it, you can count consecutive. I mean, it doesn't have to be each bar is above it. In fact, I prefer an action where it goes up, down, up, because that way you get some traders locked into longs, they're a little nervous, shorts a little nervous, and stops are more likely to be hit when it resumes, between the battle of people trying to buy the lows and sell the up moves, when it kind of jerks its way up and down, it's a little bit higher probability.